During the market rally that we've seen over the past couple of months, a concerning sign is starting to develop about market breadth. I'll explain that. And is it something you need to worry about? I've got that and more coming up. My name's Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Can this rally be sustained? Really, since we got a temporary fix, which I don't think that goes together, on the debt ceiling. You either fixed it or you didn't. I don't think they did, but we're going to kick that can down the road for 18 months. And then the Fed paused on the interest rate hike. We'll see if they have to resume, which they're sort of posturing for right now. But really ever since that, and the economy just continues to have some weak areas but still show some resiliency. Stock market's been great. Large cap stocks have been fantastic. Is there anything to worry about? Can the rally be sustained? Well, one of the things that has stood out to a lot of financial geeks like me, you may have seen this, is it seems as though there is weak market breadth. There's not a lot of participation by the entire stock market. It's really, this rally is being led by a few names. Now, this is really important. So the last time I was here on the camera talking about market breadth, it was during the rally that we saw right after COVID, 2021, early 2021. And we were looking, saying, well, geez, guys, I just want to point this out. It could be a reason for some concern, and that is that the stock market and on average was advancing, but when you look under the hood or peel back layers, it's really being driven by just a handful of companies. There's not a lot of kind of broad advance here. So, and sure enough, that what followed was 2022, one of the, a challenging time in the stock market, bear market, and all that sort of stuff. So market breadth is an issue to be aware of. If you go back to Bob Farrell's 10 Rules of Investing, now this is decades ago, market strategist Bob Farrell created his 10 rules for investing, and we periodically kind of tune into these to say, hey, can they shed some light or give some perspective as to what's going on right now? Take a look at number 7. Markets are strongest when they are broad and weakest when they are narrow to a handful of blue chip names. I mean, nailed it decades ago. What we've seen is that the stock market this rally has been really led by a handful of the largest companies, what would be considered in the past blue chip companies, and the rest of the stock market is seemingly just sort of treading water or not really contributing to the advance. Let's take a deeper look. The 7 largest tech stocks, so we got Apple, Microsoft, Google, Amazon, Facebook, Tesla, Nvidia, and this was right at the beginning of July, have returned 58% year to date through July 2nd, compared to just 5% by the remaining 493 stocks in the S&P 500. 10 stocks typically account for 32% of the S&P 500's annual return each year. So the 10 largest or biggest returning stocks account for such a large amount of the return. But look at it this year. 82% thus far, right? We're not talking about half years, but this is just halfway through the year. 82% of the stock market return is being contributed by those 10 of the largest companies. So this could be a troubling sign unless the rest of the market follows suit here. I mean, an optimist look at this is, well, hey, great. This is fantastic that a few companies have actually had a really strong performance so that it sort of masks over what would otherwise be a sort of bland time. And if we can get the rest of the companies to follow suit, then this rally is really just taken off. I would say that's a bullish case. Take a look here at a little bit more about how this market could be a little top heavy and be lacking some breadth right now. Top right is where my eye goes first. The weight of the top 10 stocks in the S&P 500. The top 10, the largest 10 out of 500 companies make up over 30% of the entire index. The S&P 500 is a cap-weighted, market cap-weighted index. So with Apple now being $3 trillion, it's going to account for a greater share of the overall S&P 500. It's not just 1/500th is what each company represents. So over 30%, you can see compared to history, that is a significant number. But then when you compare that to the earnings, stocks always follow earnings. The earnings of those companies, you can see the forward PE, the PE ratio is growing higher, meaning the market has been pushing these names up, these companies up, and in price, even though their earnings haven't grown as fast as their stock price. And you can see that in the smaller, the bottom right as well. The earnings contributions of those top 10 companies in the S&P 500, that's actually been declining since 2021. So there you have it, guys. We have a market breadth issue. The market is top heavy. And I think from a bullish standpoint, you might look and say, well, wait a second, everyone and their brother was expecting a recession to start this year, and that the first half of this year was not going to be great in stocks. The second half is when things would start performing well. And what if that would have happened minus these 7 names or minus these 10 names? What if these 10 names helped us kind of manage through what would have otherwise been sort of a murky time to start this year, and then the economy is actually going to start following suit, and the rest of the 493 companies are going to start contributing. We've sort of seen that over the past month, that a few of these companies or more of these companies are starting to get on the bandwagon here. But a bullish case is, no, this is actually a good thing. The rest of the companies, the rest of the stock market's going to catch up from here. The bearish sentiment, though, is exactly what Bob Farrell warned us about decades ago, and that is, hey, at least right now, this market advance is largely driven by just a handful of big blue chip names. And if we don't see the overall economy or the rest of the stock market sort of start contributing here and really pulling their weight and driving the market forward, then we should be on guard for this rally fizzling out, maybe not crashing back down or having a sudden drop like we saw in 2022, but at least not being sustained. So therefore, what should you do? I would give you a couple things. One, be aware that this market breadth, that is an issue. So when you're looking at your overall portfolio and your performance year to date, you might be looking at the S&P 500 and then looking at your portfolio saying, gosh, something really doesn't fit. Yeah, small cap stocks have not been able to follow in the advance. Or if you overweighted to value, or if you look at your international investments, large cap now, really driven by just a handful of names, have really outperformed the other areas, and you're going to look at your overall diversified portfolio and say, well, it's not catching up or it's not keeping up with the S&P 500. That's okay. That's temporarily how diversification works, is you're going to not have all of your eggs in one basket, meaning that some of your investments are going to do very well. So you should be holding the S&P 500 index or something similar to that. So you should be experiencing those high levels of return that these small basket of companies have performed. But then the other areas during seasons won't keep up with that, and it will balance each other over different climates. So one, know that this market breadth is an issue, and that it might damper expectations about future market returns. But the second thing that I would do is not panic, not overreact. Instead, tune into your overall financial plan, see how much risk is appropriate for your situation, both your goals and your own risk temperament tolerance, and make sure that your investments are structured appropriately for that. And then the third thing that I would tell you is tune into your investment strategies to ensure that you're using multiple investment strategies. That idea of diversification, don't have all your eggs in one basket, that tends to fail when we need it the most. When there's extreme risk, when there's a crisis, all of those areas tend to go in the exact same direction, and that's precisely when you want diversification to help you, is usually when it fails. Therefore, using multiple strategies can add more diversification. And should we see this market breadth kind of concern boil over into, the stock market's retreating, you'll have multiple strategies that should be able to help you weather that climate. Work with your certified financial planner on all that. If you don't have a CFP on your team, contact one on my team. Find us online, Korhorn.com. That's Korhorn with K. WiseMoneyShow.com. You can find us there as well, or send us an email, info@Korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.